Hello all, welcome to this new quarterly webinar session. We are going to wait 1 minute to let more people coming in. So, welcome to those who just joined. It's now time to launch the fourth EnergyScan webinar session of 2024. I'm Julien Waro. I'm in charge of the economic research team here at ENGIE Global Energy Management and Sales. So, nervousness continues to prevail across energy markets despite relatively comfortable supply-demand fundamentals in the short term, at least in Europe. Gas and power demand growth is weak or even negative across Europe, while gas and hydro stock levels sit in the upper part of the historical range or even at all-time highs in some countries. But geopolitical risk continue to fuel concerns, notably regarding oil and LNG supply flows and remaining Russian gas flows to Ukraine. So in this session, we'll give you the key elements to understand the outlook for the coming months with our speakers, Olivier Gasnier, Évariste Niouki, and Luc Ruffier. As usual, check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants and leave suggestions to the team. We'll do a Q&A session at the end of each presentation, and I remind you that the session will last 90 minutes to take as much questions as possible. Finally, you will also be asked to fill one question satisfaction survey at the end of the session. The slides and a replay of the session will be available by tomorrow at the latest on our EnergyScan platform, but you can already download them by clicking on the cloud icon on the top right corner of the screen or follow the instruction displayed here. So you click on apps, then handouts, and you should be able to download the slides in a PDF format. So let's move on to the first part of this session with the macroeconomic and oil outlook with Olivier. But as usual, let's start with one question poll. So it's the same question that we asked 3 months ago. But at this time, 3 months ago, the presidential race in the US was Biden versus Trump. So do you think Donald Trump will be elected president of the USA in November? And now the race is different. It's Kamala Harris versus Trump. So we remember that we had a large majority of yes 3 months ago, and now we can see that the results are different with now a large majority of no to the same question. So quite a change in a few weeks. So thanks to those who took the time to answer. And I leave the floor to Olivier.
Thank you, Julien. Hello, everybody. We'll have just a quick review of what was the situation 3 months ago, and by comparison, how it has evolved. 3 months ago, this to say in July, growth was weak everywhere, even deteriorating, including in the US. Now we have clearly US growth that appears resilient, but the Eurozone is in a bad shape, clearly probably close to recession. There was no improvement in China 3 months ago. That has not changed. Maybe the big change, maybe we don't know exactly yet, is that the Chinese authorities could implement a stimulus package that would be significant. Inflation was down 3 months ago, and we were expecting rate cuts, even if that had already started in the euro area in June. Now we have seen effectively the Bank of England starting cutting rates. We have seen the Fed cutting rates by even 50 basis points in September, but there are some doubts about the pace at which this will continue. There were huge political risks both in the US and France after the elections, and as Julien said, that was still Biden in the course at this time. The outcome of the US election remains highly uncertain, even with Kamala Harris having replaced Mr. Biden. I have seen the results of the poll. So there seems to be a large majority of people thinking that Trump will be beaten. It's not that obvious looking at the last polls in the US. And regarding France, we have a government, but he had no choice but to implement austerity measures to avoid a debt crisis. Regarding oil, at that time, the oil prices were higher, but the downward trend had begun on the basis of imbalance between supply and demand, especially in 2025, with an excess of supply. The fundamental situation has not really changed, but of course, the geopolitical factors have come back to the fore, and that changed everything on the market. We'll talk about that. So very quickly, just to illustrate the fact that the US economy is resilient and is quite an exception in the current environment, just two graphs. If you remember, I had already shown the first one on the left. This is the Citigroup Economic Surprise Index. And you can see that there has been a big change regarding the US. Since the start of September, US economic data have surprised positively, which is absolutely not the case if you look at the situation in the euro area or in China. Other indicator, the purchasing manager indices. This is the composite PMI, so that aggregates the manufacturing sector and the services sector plus construction as well. You can see there also that the composite PMI remains very high in the US at 54, so consistent with a strong growth, while there has been clearly a deterioration regarding the evolution in China or in the Eurozone. About the Eurozone precisely, if we look a bit more in details, the main countries of the area, you can see that Germany is leading the pack, if I can say that, to the downside. This is not really a surprise. That has been the case for some times now. And especially, we can see the situation is very bad in the manufacturing sector in almost every country. And of course, that has a big impact on the German economy, and especially in the car sector, when you can see the evolution of car registrations on a year-on-year basis in the euro area. So quite telling, I would say, this graph in the middle. Just a word about France. The French political situation is a bit clearer in the sense that we have a government. This government had no choice but to implement austerity measures to try to reduce the deficit that was expected to top 6% of GDP this year or next year. Now they only target to reduce the deficit to 5% of GDP, which is still very high. There has been no downgrades by rating agencies, but we have seen that Fitch, for example, has put the French rating under a negative review. Look at the evolution of the spread between the 10-year bond yields in some countries, including France, and the benchmark that is still Germany. And you can see how the French situation has deteriorated now. We have bond yields in France above Portuguese one, above Spanish one. The next step maybe is to have a French 10-year above the Greek 10-year. So when you remember what happened at the start of the previous decade, that's very really worrying regarding the evolution of the French public finances. In China, I won't detail, of course, all these the measures of the Chinese stimulus package that has been evoked at the end of September, and since this moment, we have seen many announcements, some disappointment, etc. I think what is important is that they intend to support the banking sector. They have cut interest rates. They will inject capital in the biggest state banks. They want to support the property market. They have implemented reduction in the rate of existing mortgages to restore households' purchasing power. They have lowered the minimum deposit required for purchases of second-hand homes. They have lifted some restrictions on the market. They will support new housing projects, and also they have implemented a new fund to try to buy a house on the market and to reduce the level of inventory, which is extremely high. They will also support the stock market, and you can see on the graph that it has been very effective, even if the last few days have been less favorable. There has been a strong rebound in the Chinese equity market. The problem now is the lack of details regarding fiscal policy, and in particular regarding the support of activity in the short term. So markets were in particular disappointed by the press conference of the Ministry of Finance last Saturday. We are waiting for that now, but I mean, I think nevertheless that it's an important step, and the Chinese authorities have decided really to try to support growth and to address this structural crisis in the property market. So in terms of growth expectations, no big change. It's about the same, but if you look at the details, for example, previously we expected some kind of convergence between the US and the euro area in terms of growth next year. That is not anymore the case. We think that growth in the US should remain rather resilient. I mean, there is no sign of immediate downturn in the US economy. For the euro area, that would be the third bad year in a row with growth below 1%. For China, we have upgraded a bit the forecast for next year, still below the 5% official target, but nevertheless, that should support growth, and we still expect global GDP growth to be around 3%, which is rather low by historical standards. Inflation. I had a word about inflation at the beginning, saying that yes, 3 months ago there was clearly a fall in core inflation that was leading to the conclusion that there would be interest rate cuts by the main central banks. This has been effectively the case. You can see that on the graph in the middle the monetary easing has started, whether you look at the Fed, the ECB, or the Bank of England, while on the opposite, the Bank of Japan has started to hike rates and to end, this abnormal monetary policy that was linked to deflation. when you look at the evolution of core inflation on the graph on the left, you can see nevertheless that there is clearly some difficulty to go lower. That's obvious in the euro area. That's the case also in the US, in the UK, with core inflation remaining around or even above 3%, which is much above the official targets for the central banks that is at 2%. And that is linked mainly to the fact that the job market remains in general in those countries in good shape with a strong increase in wages. And you can note also the plunge in the Chinese inflation rate, which is now very close to zero for core inflation. It was 0.1% in September. And that can explain the fact that Chinese authorities have reacted and want now to try to support activity in order to avoid a kind of Japanese scenario of fall into deflation. I would like to underline the fact that there were very aggressive expectations of Fed rate cuts some weeks ago, especially after the September meeting. And now that has completely changed. If you look at the graph on the right, this is of the level of Fed funds rate expected in June 25. And you can see that there has been a correction of 75 basis points, which correspond to 3 rate cuts. Rate cuts, of 25 basis points by mid-year next year. So this is a huge correction. By comparison, you can see that the change for the ECB has been very limited. And now you have even the prospect of ECB rates falling quicker than the ECB rates, which of course is quite a different situation. And that has some consequences for the evolution of the euro dollar. You can see there on this graph the comparison between the evolution of the spread on the 2-year rates, so Germany minus the US on the right-hand scale, and the evolution of the euro dollar. And you can see that there has been really a plunge in the widening in the spread between the US and German rates, and of course the euro dollar has fallen, but there is probably a room for maneuver for more downward adjustment in the euro dollar in the short. Okay, now I would like to conclude this part on the macroeconomic situation with a word about the US election. Of course, everything has changed following the replacement of Joe Biden by Kamala Harris. On the graph on the left, at the top, you have the evolution of polls. And you can see that Kamala Harris is clearly above Donald Trump. That means that she will win, without any doubt, the popular vote. But if you, for example, if you take the example of the 2016 election, when Donald Trump was winner against Hillary Clinton, he had 3 million votes less than her. So he lost the popular vote, but he won the election. That is linked to the US electoral system, which is clearly in favor of the electoral map is clearly in favor of the Republicans. Then on the other graph, you have the evolution of the bets for example, I have put poly market, but you have also predict. The idea is that if you look at the very recent evolution, there has been some change with clearly more bets in favor of Donald Trump victory than Kamala Harris. So people think that it's the formidable increase in Kamala Harris chances to win the election are fading a bit, and Donald Trump is taking the advantage again. It is very recent, not linked to one particular event, but this is a general evolution. And to finish the map with the US states, you can see that there is in blue you have the states where the Democrats are likely to win. In red or orange, you have the states where the Republicans are likely to win. So this is almost equal. And in gray, you have what we call the swing states, where the competition is extremely close. If you don't consider the swing states, Donald Trump has taken the lead also in the very last few days. He has quite a large majority, and this is linked to the fact that in the swing states you have the latest polls that are just at the bottom. Trump has the advantage almost everywhere except in the Wisconsin, where Kamala Harris has the lead. So if you refer to those polls, Trump should win the election. But what I wanted to underline is the fact that things can change very quickly, because if you look at the difference in polls in all those states, in Pennsylvania, North Carolina, Arizona, Georgia, Michigan, Arizona, I mean, the difference is always below 1 point, which is not significant in terms of, statistical. In terms of polls, it's not significantly different to have such a narrow difference. You can have some errors linked to the polls, and you can have something very different in terms of results compared to the polls. So the situation is extremely close, and probably the result of the election will be very close as well. So imagine that Mr. Trump is losing again after 2020. We could have the same kind of scenario with him refusing to admit his defeat, etc. So this political uncertainty in the US may probably last until the elections and beyond if we have a very close results after the election. Now I would like to say some words about the oil market. As I told you, so when we at the last webinar that was in July, prices had started to fall. That was after a weak Chinese GDP numbers. Then there were also some worries regarding the US situation, etc. On that, on those prospects of an imbalance with excess supply in 25 led the Brent prices below $70 per barrel. And then we had, of course, the deterioration in the situation in the Middle East and this stimulus package announced in China. And that has bring back prices of Brent closer to $80 per barrel. We had some news overnight with a new fall in prices as according to the Washington Post, Israel won't attack the oil installations in Iran. I will come back on this. So you can see on this, on this graph that fundamentals have pulled down oil prices clearly to below $70 per barrel, but geopolitical events plus this announcement of stimulus package in China has triggered a rebound. So the baseline scenario, if you want, if you look just at the fundamentals, it is that the market will be imbalanced in 25 compared to 24. Now the situation remains quite favorable to and quite supportive for prices, with stocks being on the decline, as you can see on the at the bottom of the table. But that will change because OPEC will increase its production, the non-OPEC countries will also increase production, and demand will be weak. So fundamentals point to excess supply and lower Brent prices. This is what you have on this graph. This is a graph that I put in the last monthly that you can find on the EnergyScan website. We sent it on last Friday. But of course, there are some risks on both sides attached to the evolution of supply. The first risk that seems to have diminished is linked to the tensions between the I don't know if we can say war, but clearly the attacks between the Iran and Israel. A risk that, of course, could affect all the region and all of course, the oil market. The first thing to look at is the evolution of output on exports in Iran. Despite the restriction, the sanctions against the Iranian oil sector, we have seen that the Iranian output has recovered and now exceeds 3 million barrels per day, of which there are exports towards mainly China for 1.8 million barrels per day. So this is quite significant. If you imagine, for example, that Israel could target the Iranian oil installation, in that case, they would probably target the Karg Island, which is the point of departure of 90% of exports of Iranian exports. But you could also, in that case, you could imagine that Iran would respond. They would try probably to block the Strait of Hormuz, which is extremely important for the oil market because there is roughly a traffic that via the Strait of Hormuz that correspond to 1/5 of daily global oil consumptions. So it's very important. You could also imagine that Iran, via probably the Yemeni tribal, the Houthi, would try probably to target the Saudi oil installation. That has been already the case in 2019. In 2019, sorry, if you remember, and they had been quite successful. So there is a kind of nightmare scenario where all the Middle East enter a kind of war where the oil sector is deeply affected with a slump in the supply that would send the oil prices to, we don't know, 130, 150, something like that. This is the first risk. But apparently, as I said, according to the Washington Post, Israel is ready now to listen to the US and not to target Iranian oil installations when they will reply, because they will reply, of course, to the last attack of Iran against Israel. Second risk, which is the opposite one. As I told you, there will be an increase in OPEC output that is scheduled for the next few months, that had been announced early June. It was for October. Given the fall in prices, the OPEC Plus group had decided to postpone that to December, but apparently they are now ready to increase output, and that will bring back the level of output of OPEC Plus to the level at which it was at the end of 23. So it corresponds to an increase in oil output of roughly 2 million barrels per day in 25. There is another scenario, which is an extreme one. According to many unofficial sources, there are tensions inside the OPEC Plus group. And Saudi Arabia is really fed up with the fact that Iraq, Kazakhstan, and probably the United Arab Emirates in particular, they constantly exceed their production quotas. So Saudi Arabia which has a spare capacity of 3 million barrels per day, could decide to completely change strategy, as they did already in 2014 and also just before the pandemic in 2020. They could choose to flood the market, increase their production, and in that case, you could see the prices going sharply downward to 50, 40, 30, or even $20 per barrel. And in that case, the advantage would be to, of course, to reduce drastically the level of the shale oil production in the US. So this is another scenario completely opposite to the first one. But you can see that finally we have an intermediary scenario which is not completely satisfactory, and you have big risks on the upside, on to the downside on the oil market. This makes the situation deeply uncertain for the coming quarters. Okay, I'm done, Julien. I don't know if we have time to take just a few questions.
Yeah, let's take a few minutes. So we have several questions. So first question regarding the French situation. Have you measured what could be the negative impact of the French budget fiscal package on growth?
Yes, well, the estimates are around probably half a point of GDP, something like that. The budget is built on a scenario of growth exceeding 1%, which looks frankly really optimistic, especially in a very unfavorable European environment where German growth is weak. So that looks probably too optimistic, and that could trigger new austerity measures in the course of 25.
Okay, thank you, Olivier. Second question. How would the markets react depending on the next US president? Even if Trump appears to be more unstable than Harris, it seems that both candidates might be considered as a good signal for US local economic growth.
I'm not sure of this one. I mean, at the beginning, all the estimates that have been made about the economic program of the candidates showed that there would be a negative impact of Trump program because it is much more radical than its first mandate, with a sharp increase in taxes, in particular for imports, and in particular for Chinese imports, that could have clearly an inflationary impact that would reduce the potential for the Fed to cut rates, and that would have, all in all, a negative impact on growth, because that clearly this is the US consumer who would pay for these higher taxes, and that would be negative for global trade, etc. But when you look at the evolution of Harris' programs, I mean, she tries to stick to the Trump economic proposals, meaning that the position of the Democratic administration has evolved and is more and more radical, especially regarding the relations with China. So all in all, I'm not sure that we can say the both candidates' program might be considered as a good signal for US domestic growth. No.
Okay, thank you, Olivier, for your answers. So it's now time to switch to the gas part with Évariste, and as usual, we'll launch a one-question poll. So, question on natural gas supply risk. So, do you think that some Russian gas will continue to flow through Ukraine in 2025. So as a reminder, there is a 5-year transit contract between Gazprom and Ukraine that is expiring at the end of the year, and one of the key uncertainty on the gas supply side in Europe for next year is the continuation or not of this transit. So let's have a look at the result, and it's quite mixed with like a 50-50, just a small majority of no, but it's really mixed. So quite interesting, Evariste, to discuss on this natural gas outlook. So thank to those who took the time to answer. So the floor is yours, Evariste.
Thank you, Julien. Mixed response, surprise for me, because I expected a more clear answer from the audience. We'll see very soon what is my own opinion about that. So to start, let's just look at the European gas balance and to see how it evolves in the previous months. So here you have the data up to September. So the trend for this year is quite clear now. On the positive side for the balance, and we already pointed this one during the previous webinar, rebound in Norwegian supply, the same for Russia, and of course on the downside, very strong drop in LNG supply. On the demand side, after the strong drop of 2023, the drop is smaller this year. We are talking about minus 2%. And when you look at the sectoral split, it's not the same in every sector. You have this rebound in industry, a little bit above 7%, strong drop in power generation, and rather stable in local distribution, so mainly residential and commercial. So overall, when you look at the trend in stocks, they are rather comfortable, although there is a slight tightening, because we'll see that in the previous week, the Norwegian supply was a little bit below what the market was expecting. So stocks are comfortable, but they are now slightly below last year's level. You can clearly see it on the graph. Mid-August, precisely on August 19, we reached the 90% target set by the European Commission. So the 90% target was reached well before the deadline, but this doesn't mean that that stock will remain stable, and you see clearly that they could be threatened by a set of factors. I talk about the drop in Norwegian supply. There was there were heavy maintenance works in Norway at the end of August, early September. So this weakened significantly Norwegian supply. And then afterwards, the ramp up after the maintenance was too slow. So Norwegian supply was expected to increase strongly after the maintenance, but since then we are seeing a lot of unplanned maintenance due to some technical outages. This means that some volumes are missing on the stocks. That's why when you look at now the stock as of October 12, yes, they are still comfortable, but we are below the 97% fullness of last year. It is not worrying yet, but it means that you have to be careful. You can no longer say that stocks are comfortable, and I can do without LNG, for instance. And of course, prices reacted to this situation. First, we can point what happened on September 19 with the news. It appeared to be fake news afterwards. The news that Ukraine has agreed to transit some gas from Azerbaijan when the transit deal with Russia will expire at the end of this year. So the answer of the audience about the expiry of this transit deal is interesting. It just means that the market doesn't know yet. So things are not so clear about this transit deal. It also explains why the market was so nervous about that news. So, as I said, the news was quickly dismissed by the authorities from Ukraine and Azerbaijan. Afterward, prices rebounded. They weakened again on October 7, before rebounding again on the news that a Japanese company was having trouble with one of its nuclear power plants, which highlight again the risk on the LNG supply. All this to say that when you look at the price trend, you see that prices, let us say early September, they drop both on the month side, on the calendar contract. They drop slightly below the 1-year average before rebounding very significantly. And when you look at clearly the graph, you see that now we are above, let us say, slightly below the 20-day average, so short-term bullish trend, and above the 1-year average. The question I ask here is, can we still expect the prices to return to the 1-year average? It is still possible, but for the time being, there are a lot of risk factors. I talk about Russia, I talk about LNG. All those risk factors are preventing the market to drop back again toward the 1-year average. So having said that, it is now time to detail these risk factors, starting with Russia. So Russian flow, despite the war, are still sent to Europe. We are talking about a million cubic meter per day. You are at 40. On a yearly basis, you are talking about 15 billion cubic meter. So the news, I talk about the news on September 19. Our personal opinion is that there will be no Russian flow via Ukraine next year. I hope I will be wrong. Because I see that half of the audience is sharing this view. So no transit from Ukraine for next year. We'll see what will happen. All the countries that can do without Russian gas, for sure, they are doing all their best to avoid that. They are importing via the other countries. Some of them, they can take probably more flows via the neighbors or via LNG when they can. But for most of the countries, it is quite difficult. So here we are talking about the flows via Ukraine. You will see later on that Russian flows, total Russian flows will still be sent to Europe via the pipeline named Nord Stream 2. So some countries will still receive Russian gas. The flows we are talking about here are clearly those via Ukraine. So this is for Russia. The other risk factor clearly, and the more important one, I must say, is clearly on the LNG side. Here you have the view on LNG exports, both for the US and worldwide. So when you look at on the graph on the right, the global LNG export, you see that since early September they are up. So rather good news for the global balance. So flows are up, but there are some risk factors. First one is clearly in the US. So far, the hurricane season has not really disturbed LNG supply. You can see it on the graph on the left. You have a lot of hurricanes, Francine, Helen, Milton, with major fatal accident. But for the LNG market, there was no real disruption. So flows are still there. But the hurricane season is not over yet. It lasts until end of November. So you can still have some disruptions. The other risk factors is clearly what is happening in the Middle East. Israel is a major gas producer. You have to keep it in mind. We are talking about 25 BCM per year, around half of it being exported via pipeline to Egypt and Jordan. if those countries were to miss the pipeline flows from Israel, of course, they will have to turn more to the LNG market and increase their LNG imports. The other risk is clearly, and probably the most important one, Olivier already talked about it on the oil part. So the Strait of Hormuz is important for oil transit, but not only. It is also very important for LNG transit, because around 20% of global energy supply is transiting via this Strait of Hormuz, mainly from Qatar. So you can imagine what will be the global LNG balance if you were to miss those flows from Qatar. So risk factors on the supply side, meaning that all the buyers are still a little bit worried. And clearly Europe, particularly if you assume that we'll be missing Russian flows via Ukraine, Europe will have to continue to compete with Asia. When you look at the graph on the left for Asian LNG imports, you see that they are rather strong. Since early September, they are even above last year's level, meaning that there are less volumes available for the other regions, in particularly for Europe. Hopefully, thanks to higher supply, particularly from the US. And when you look at the graph on the right for European imports, they are rather resilient, particularly because of this improved supply. But they are clearly at risk if you assume that for the end of this year or next year, Asia continue to import more year on year. Particularly in a context where total LNG supply is not expected to increase strongly for this year, for the end of this year and next year. When you look at the last report published by the International Energy Agency, they say that this year LNG supply will increase by only 10 BCM. It is very weak because it is the weakest growth rate since 2020. For next year, flows will be a little bit higher. You are talking about 30 BCM for 2025. You should have to wait 2026 to see a significant increase in LNG supply. So when you look at the LNG balance, from 2026, yes, the global balance could be more comfortable. But in the meantime, for this year, end of this year and next year, clearly there is a risk because you could have a competition to attract LNG cargoes, to have part of these 30 BCM we expect for next year. So this leads us to our scenarios for next year. And what you try to forecast is clearly the stock levels for Europe at the end of 2025. First, we just extend the trends we are seeing currently in terms of demand, in terms of LNG supply, in terms of domestic production, Russian flows, and so on. And we end to say that at the end of this year, Europe gas stock should be around 90 BCM. This is slightly below last year's level. This is our starting point. And then you have to make some assumptions for the other components. We assume Norwegian supply to remain stable at 115. Russian supply, here we keep only the flows via Nord Stream 2. So no flows via Ukraine, zero flows. So we missed the 15 BCM from Ukraine. Domestic production, slight drop, let us say almost stable. The same for North African flows and Azerbaijan flows. We didn't show here export to Ukraine, but we maintain them stable. And then, having said that, we can focus now on the two main risk factors, demand and LNG supply. And then you have to look at the table we put aside. On the demand side, what we say is that the central case is clearly maintaining demand at this level. So 366 is the same as last year. The same as this year, 2024, which is not yet last year. And then we assume as a low case, a slight drop as similar to that of this year, minus 2%. So this gives us the 359 BCM. And then on the upside, you can say that the rebound we are seeing currently on industry, as a reminder, plus 7%. Imagine you have the same rebound in power generation, because on power generation, we are lower thanks to higher nuclear, we are lower thanks to renewable or hydro. If you don't have those elements at high levels, you can see a rebound. So in this high case, we assume a rebound in power generation, and the same, you can assume as well a rebound in gas demand in local distribution zone. So here, the high case is assuming a 8% increase. And this gives us a value at 395, which is still below the level of 2022, which was, as a reminder, at around 403 BCM. So strong rebound in gas demand. So this is for demand, and then let's switch to the row part of the table on LNG supply. Central case, of course, when you miss 15 BCM of Russian gas, it will be difficult to assume that Europe will continue to import the same volume of LNG. So in the central case, we assume that we replace the Russian gas by LNG. So we add to the 120 that we expect to be imported this year, we add the 15 BCM. So this is the central case. On the low case, yes, you can say we continue to import 120. And on the high case, we increase even more the flows. Europe import 20 BCM. As a reminder, we expect total LNG supply to increase by 30 BCM. So if Europe is taking 20 BCM out of 30, we are just assuming that in this high case, Europe is taking the lion's share of the additional LNG supply for 2025. So then you have all the scenarios, the nine scenarios. You don't have to look at them all. Just focus on the one we point here, scenario 1, 2, 3. Taking those scenarios, you have all the set of likely outcome. What the table shows is that, yes, in case cold weather, weak renewable, nuclear, hydro, force Europe to increase significantly LNG imports, because it will be the only way to maintain the stocks at rather acceptable levels, the other region will have to reduce their own LNG imports. And when you talk about the other regions, clearly we are talking about China. And here we put some assumptions for China LNG imports. In the central scenario for China, we assume that China will increase its LNG import by 11 BCM. China should continue to increase strongly its domestic production, which is increasing now by 5% year-on-year. We assume that they will maintain that pace. We assume as well that they will increase their pipeline imports. As you know, China is now importing on top of the pipeline imports from Turkmenistan and Uzbekistan and so on. They are importing more and more pipeline gas from Russia via the power of Siberia. The assumption here is that the power of Siberia, whose capacity is around 38 BCM, will reach its plateau phase. This is the forecast on the pipeline should reach next year its full capacity. So this is adding the volumes you have here for the total pipeline imports for China, 8 BCM. So when you say that, you take total domestic production, pipeline imports, and the assumption about LNG imports, you have a value for total gas supply. And this value with this assumption, should increase by 6.3% year-on-year in 2025. The question now, because energy needs are just to fill energy imports or supply, are there to fill some needs. In China, there is still a strong correlation between GDP growth and energy consumption. Olivier talked about the GDP target, the official target for GDP for China, around 5%. And if you look at the table shown by Olivier, you see that we are slightly below. It means that GDP could be even below the 5% target. Given the strong correlation between GDP growth and energy consumption, you can say that energy consumption should increase by around 5%. If you say that gas supply is increasing by 6.3 versus 5, you assume that gas is increasing its share in total energy supply in China. This was the case in the periods where gas prices were rather low, meaning that in the periods where China knows that in the global market it can import LNG at low prices to fulfill its growth without hurting this growth with high inflation and so on, they do that. But if tomorrow you say, okay, I want to increase my global gas supply by 6.3%, but at the expense of high gas prices, I'm not sure that China will continue to do that. So 6.3%, yes, if gas prices are rather weak. If these LNG imports were to increase a lot, the gas price, I think that China will say, okay, I will just make some substitution because I have the choice, they have the choice to switch to more coal and reduce the share of gas. That's why we are rather optimistic about the fact that China is a risk factor for the LNG market, yes, but it's also a balancing factor. If LNG imports were to be too high and to pull prices up, I think that they will reduce this LNG import from 11. They will say, okay, we go to 0. And in the market, some are even talking about China being able to sell LNG in the market. So this means that this is a scenario you cannot totally exclude. Risk factor, but also balancing factor for the market. So to finish, let's look at what the market is telling us. When you look at the forward curve, and the impact of oil is clear in this graph. In fact, until end of September, the strong drop in oil prices exerted downward pressure on coal prices. So oil prices are in blue in the graph. You see that when you look at prices for 2025, oil is exerting downward pressure. This is on an average basis. Of course, given the seasonality of gas prices, you can have some periods where gas prices are above oil prices. But on a yearly basis, oil continues to set a kind of maximum to gas prices. But recently, with the rise in oil prices, you see that now TTF prices are very close to oil prices. Since yesterday, oil prices are dropping again, meaning that you can see again a downward pressure exerted by oil prices on gas prices. On the downside, we continue to believe that the price of US LNG to Europe will continue to set a minimum for gas prices. And on this minimum, you have to add one. If you link it to what we say about China, the price substitution for power generation between gas and coal will more and more have an impact on the European gas market. We added here, we just take into account the efficiency factors. There is no carbon cost in this one on the dark gray, while of course on the European price you have a carbon cost. There is a carbon market in China, but at very low prices. But you can assume that the more in Asia, they will try to make a kind of substitution between gas and coal, to go to more gas and reduce the share of coal. They could increase the carbon price, and then at some point you will have a conversion between the dark gray and the light gray curve, meaning that you have a global, let us say, switching price for power generation on a global scale between gas and coal. We are not there yet, but for the time being, for sure, when you assume a balance for the gas market more and more, I believe that you have to take into account this substitution cost in Asia. So that's it for me, Julien. I don't know if you have some questions for me.
Yeah, thank you, Evariste. We have several questions. I'm not sure we will have enough time to answer everything, but let's start with the first question regarding LNG supply. Do you think the massive additional LNG capacity from US and Qatar coming live as from next year is already priced in today's futures for TTF Cal 25, Cal 26?
Yes, and then we can just say it in this graph to answer it. For next year, I'm not sure, because as I say, for next year, 30 BCM is not massive, but clearly from 2026, the strong increase in LNG supply is seen in the market. Also, the disconnection you see here between gas prices and oil prices, with gas prices dropping close to what we estimate to be the bottom. This disconnection is clearly the consequence of this additional LNG supply.
Okay, thank you. Next question regarding LNG. At what price level do you see China reducing LNG imports?
Difficult question, because maybe you don't need to look at it in terms of price. Just remind what I say about the 5% growth. Price is just a consequence, of course. If you say by continuing to add some LNG, I'm able to maintain this 5% growth, you will not stop. It just means that even though the price of LNG is very high, if you are able to pass on this price to the consumer and continue to support your growth, you'll continue to do that. So the question is, if LNG prices were to be very high, will they be at levels still acceptable to support a 5% GDP growth in China? This is the real question. And my answer is no, because as Olivier said, you see that in China, the core inflation is very weak, because when you say core inflation, it means that at the start of the process, you also have the PPI, the producer price. If your producer price is at zero, very close to zero, you cannot accept to pay a LNG price at high levels.
Okay, thank you. One last question for you, Evariste, regarding market positioning, which is quite a strong indicator now. Net positions of investment funds are almost at their all-time high for TTF contracts. Do you know more about the background and the story behind it?
Good question, but no, I don't know. I would like to have the answer, so it will be much more easy to give you an outlook. But what we can say that with this positioning, in fact, you can have some optimistic and pessimistic outlook. On the pessimistic one, you say that yes, they are bullish, they are pulling the price up. On the optimistic one, you can say that the day they will cut this long position, of course, prices will drop. And on top of that, I believe that they are taking long positions. But if you look at the commercial, because you only focus on the investment funds, but in this market, the lion's share of the open interest is in the hands of commercial players, those commercial players are not so bullish. So the real view, fundamental view for me is coming from the commercial players. They are not so bullish, so they are rather short or stable, while funds are bullish. We don't know who will be right.
All right. Thank you, Evaris, for your answers. So there are some questions that we don't have enough time to answer, so don't worry. We will take the time to write an answer for you. So it's time to switch to the power and carbon section with Luc and a short poll to start again. So now a question regarding power demand. So we talked a lot about gas supply risk, but what about power demand? This is a key uncertainty for the coming years, clearly. So do you believe in a power demand boom or strong increase in the next few years, notably on the back of the electrification of some usages like transport, residential heating, or some industrial processes? So please take 1 second to answer. So we see quite a large majority of yes. So most of you are betting on a strong increase in power demand in the next years. So that would be interesting to discuss, Luc, in your outlook. So thank you, guys. I'm just closing the poll, and we launch the last part of this section. So the floor is yours, Luc.
Thank you, Julien. Okay. Thanks, everyone. So I see that time is running out. So brace yourself. Bear with me for a few more minutes. I'm going to try to give you a comprehensive overlook of what's been going on the power market, and at the very end, I'm going to have a word on the carbon market as well. So the first thing I wanted to start with is an overview of the supply and demand evolution of the European power balance. So on this waterfall chart, you can see the demand on the two big blue bars and the decomposition of how we've been supplying this demand, the change in supply in the bars in the middle, so by type of generators. So first thing we can see is that demand over the Q3 of 24 against 23 has been increasing by a bit over 1.4%. That's a moderate increase compared to a bottom that we've seen in 23, but it's let's say a good sign, a good start of a recovery for what's coming next. Now, how did we supply this slightly higher demand? So the first thing we can see is that renewables, especially solar, over the summer in Q3, have really been a big part of this increase. So solar has produced more than 19 terawatt-hours more than last year. That's mainly due basically to capacity additions. We've had sunny conditions, but it's mainly due to additional capacity. On the other hand, wind, both onshore and offshore, has really been an underperformer. We're going to see that in the next two slides. But that really shows that despite new capacity, we will have some years or some periods of time where we just don't have as much wind as the normal scenario would predict. We also have higher hydro. That's a trend we've been observing since the beginning of the year, and it continued in Q3 and mainly in September. Nuclear as well has been recovering, especially in France, and despite closures in Germany and Belgium. And those increases in low carbon sources have really been impactful on the other side. On the left side, the third one here is that it's been displacing fossil fuel generation. And that's really important for prices, because the more hours you have set by fossil fuel generation, basically the higher your power prices can be to some extent. We're going to come back to that later. So if we dig a bit more into the demand, we can see that if you focus a bit more on the central Western Europe part, July and August have been strong months for demand. That can be explained through demand for cooling, as we know that there's an increase in installation of AC. September, however, was a bit more disappointing, as we didn't have really high temperatures that really stimulated cooling demand. We were in an in-between season where there's no heating or cooling really, so it's a bit more neutral in that sense. But if we compare to what we've seen in the past, well, we're still very well below pre-crisis levels. We have dampened levels of demand, but we have some let's say some hope that it's the start of a recovery, especially driven by a few countries. So we can quote Italy, Spain, for instance, and the Nordics mainly, which are doing better. But some countries are still lagging behind. So France, for instance, has only slightly improved by 0.85%. So there's definitely some room to go. And the big question will be for this winter: are we going to be able to see? Are we going to be seeing an increase in demand to the same extent, or are we going to keep the same heating behavior in the power sector? So are people going to be more sober in terms of power demand for their heating, or industrials for the processes? That's really one thing that is really important for the upcoming months. Now, if you go back to supply, well, I've mentioned it already. We've had an incredible hydro generation over the past few months. Wind was pretty low in the summer, so July and August, you can see in the upper right chart, were just in the historical range despite capacity additions and much below 23 level. Nuclear was on the bottom left chart, was basically back at pre-crisis levels. So that's really well, it shows really good health, and you can see that there's very strong modulation, which indicates that basically the nuclear fleet are almost maximizing the output. They are just making room when there is more renewable, or they are ramping down when there is lower demand, such as in the weekends or bank holidays, for instance. And so the conclusion of that, as I already said in the previous, the first slide was basically we have lower generation from fossil fuel generation, and mainly gas, which is the main source in Europe. But it's important, I think, to give some nuance about this, because compared to what we've observed over Q2, so April, May, June, and compared to what we've seen in July, August, September, we see a slight increase, which is normal in the sense that Q3 is supposed to be a period with a bit less hydro than Q2, a bit less wind as well. As you can see, the seasonal pattern shows really low wind in Q3 usually. So that's not surprising, but we're going to see that it has had an impact on prices actually. So this lower wind, a bit higher generation from fossil fuel generation has been visible on the spot prices. As you can see in July and August, you have a gradual increase in spot prices, which really reached basically a year-to-date high in August during heat waves, where you had a really big need for thermal generation to ramp up, as there was basically no wind or solar in the evenings. So that's one thing that we'll have to monitor over the next few months. Is basically wind going to be able to crush power prices to the extent that winter prices are going to be at the same level or as summer prices, or is it going to be even lower? That's really an interesting question that could really reshuffle how power prices are redistributed. And Also, the increase in renewable generation, mainly solar, which is to some extent a bit less flexible in the way that it has basically set hours every day. We know it's a very predictable pattern, and all producers are long at the same time, they are short at the same time. So it's really, there's a recurrent pattern of oversupply basically in the market. And that's what reflected in hourly spot prices, negative prices mainly. Here it's not strictly negative, so it includes the zero price. But you can see that in 24 in Germany, we've really been hitting records. We are already close to 500 hours with negative prices. And if you continue that trend, a year has about 8,000 hours. So at this pace, we're already at 5% of hours which are negative. At this pace, in the next few years, we could see 10% of the hours which are negative. So that's really huge. It's just a symptom of to see that of the market that shows a lack of flexibility and recurrent oversupply. Now I'd like to focus a bit more on France, and I have a word in Germany as well, because the different. It's really interesting to see how the local, regional supply and demand dynamics are evolving, and how what does that mean for power prices. So the first thing is that, as I said, on the back of the increased performance of nuclear generation, France, the French market has basically been in some kind of an oversupply since spring. At this time, we saw really record numbers of negative hours, also due to grid constraints, which have now been resolved. But over September, on some days, thanks to really impressive hydro generation, as you can see on the upper right chart, we've been still in this oversupply. Prices were really down. Another symptom is clue, let's say, that the French power market is in an oversupply is the cumulative net imports. So we are 2 days ago we were standing at minus 69 terawatt hours. So that's 69 terawatt hours which were exported to mainly Italy, Germany, because it's now a net power importer, and that's really a record high level. And 2 years ago we were the outlier in terms of imports, and 2 years later, thanks to better operational performance, it is now the complete opposite. As I said, also demand is pretty low, so that explains this oversupply. However, there's some more news to bring, I think. We see that on the left chart that we are basically back in some kind of the 2023 range of this French gap that we called over spring, which shows that basically as the situation improves, we could see closer to normal hydro situation, wind as well, so that could help ease the oversupply we can see. Now, if we move to Germany, just across the border, the situation is very different. We've had closures of nuclear plants in 2023, more closures of coal plants this year in April, and that's really been impactful for the power market, as it really reduces the margin, or let's say the buffer the market has to react to the shifting levels of generation in renewables. So I highlighted in this chart, this is hourly production and price. I wanted to show here 2 regimes. The first one is on the left. It shows basically that on the weekends, for instance, so August 31st and September were the weekends, at this time we had really high temperatures. So demand was higher than usual, but lower than during weekdays. You can see that we basically had Germany exporting power during the solar hours, even going to negative territory on some hours, as demand is pretty low on Sunday. But then, as the the week starts, we have Monday and then Tuesday, we have lower lower solar generation, and especially record low wind generation in the evening, while demand is still really high. That means thermal generation has to ramp up, gas plants, coal plants have to turn to switch on, and Germany is trying to maximize the imports it can get. And despite that, you still have power prices really skyrocketing, over 600 euros per megawatt hour, and at 7 p.m. I think it was. So that's really a symptom of how the market is tight in Germany, and that's a risk to consider for the future. That explains also why German prices have not fallen in such a way as French prices did, and are really much still exposed to the gas market dynamics. Now, if we have a word on the forwards, on the left you have weekly averages for spot prices. On the right, the Cal +1, so the 2025 base contracts. So over the summer in mid-August, we've had this phase of supply disruption on the gas market due to the Ukrainian incursion in Russia. So that a possible halt of the Ukrainian transit, which did not materialize. So as LNG imports were back, prices declined. You can see a pretty sharp decline in the fuel costs. That was also impacted to the downside power prices. Then in September, we've had a stabilization, a slight rebound of both gas and carbon prices. Carbon prices, I'm going to talk about it in the next few minutes, but they've rebounded just from a compliance point of view, thanks to late buyers who rushed to the market, and but basically the carbon price fell just after again. So there was also a downward driver for power prices. Now, if we are kind of in a wait and see approach now ahead of winter, and at the mercy of geopolitical developments in the Middle East or in Eastern Europe. So for the clear direction on the power price, it's mainly going to be driven by gas again, and carbon, which also can follow gas. So it's mainly gas driven. However, if we look at how the local markets are evolving compared to one another, we can see that over the summer we had actually a pretty interesting decoupling of Belgian prices to German prices. That can be explained as Belgian prices benefit from high power exports from France to Belgium, so they benefited from this oversupply. They have up to 6 gigawatt of capacity, so that's really huge. But some, let's say, some damages were found on one of the nuclear reactor in Belgium, and it's been unavailable for another month in November, and there are risks that this situation could linger into the future and potentially impact the winter, when the nuclear plant is actually very much needed. So the Belgian prices reacted a bit more to the upside, closing the gap again with Germany. But that's driven by the Belgian fundamentals. So that's really one thing we will need to monitor, is the dwell for nuclear plant availability. On the French side, basically, France became the cheapest power market in Europe very briefly at the end of September or mid-September, below Spanish prices. But those Spanish prices have acted as a support, let's say, to French prices, which are now moving up. But it's really interesting to see how this oversupply in France can fade and is reflected into the prices. And as a result, the German to French spread is slightly closing now over the past 2 weeks. So it's going to be interesting to see how that unfolds further into the winter. Now, what can we expect from the power market? So but the question you answered in the poll was really about demand. That's really a big uncertainty we have on the power market. On the supply side, we roughly know how much renewable, how much renewable capacity we have on the market, but the question remains: what kind of level of demand we'll have to put in on the other side of the balance? We know that it's going to grow, but the pace of the growth is really uncertain. As I showed you at the beginning, we have 1% growth, so can we really call that a boom? It's not yet certain. You have also a political context that weighs on this potential demand growth. If EV sales are dropping, as Olivier showed, that's really a big concern. If you have political turmoil that can discourage investors to invest in data centers in France or in Europe in general, that's also going to be an issue. So that's really concerns that are we are trying to monitor. It's big assumptions we have to make on the future, but it could be a bit better to be on the modest side of growth in the 1-2% range when we go back to pre-crisis levels. And one thing I wanted to highlight is also that for this winter, the German prices, well, if we only look at powered only drivers, cold snaps in this winter are really going to be able to retest the German supply stack. We've seen tightness in late August, early September, as I showed you. But what is going to happen when we have even higher demand, no wind and cold weather? That's really going to be interesting. It could also have a ripple effect on neighboring countries. That's also going to be interesting to monitor. If we see prices soaring dramatically, that could also be reflected on the power forward prices. So really, that's something to monitor. And as I said, for Belgian prices, nuclear availability is going to be key. Now, a very quick word, I see time is running out, about carbon. So carbon prices have been on the downside for the summer, a slight uptick in price at the end of September, the 30th of September, where we basically had the end of the compliance period. Some buyers rushed to the markets at the same time as gas prices increased again. And that really led to a really short-term rebound that faded and price dropped just below 60 euro per ton. That's a level unseen since April 24. But it really reflects the bearish fundamentals that are developing in the market. So really high renewables, very bearish industrial activity. Olivier mentioned it, but Germany, which is usually the powerhouse of the industrial sector in Europe, is not going great, and that's not helping the UA market to move higher. That's for sure. If we look a bit about speculators and their positioning, we see an increase in the net short position again. That's the black line on the left chart. And they are following the price developments, but we know that they can increase volatility, and that's what we've observed with a rebound from the 60 euro per ton level to above 65 in just 2 days. So like they can really shift the market heavily, but they can also bring it again to the downside. If I talk a bit about coal and gas, basically as gas is still posed by geopolitical risk, coal is a bit lagging behind, so that gives a bit more room for coal plants to still remain in the market, and that could be a tiny upward price driver for emissions. And now on the outlook, as I said, industrial demand is still very gloomy. And we still have high renewables, high hydro stocks. So the upcoming weeks and months are not looking super great for carbon prices. However, as we have more sectors entering the ETS market, we could see the long-term increase finally kicking in. as the supply and balance moves finally into a net short position. Back to you, Julien. I hope I have questions. I cannot hear you. That's an issue. Yeah, Julien, I think we are missing your mic. I guess you can put one question and I start to answer while you figure out your mic.
Okay, do you hear me now?
Great.
Okay, sorry for that. So question, so I'm just gonna launch the satisfaction survey and ask the questions at the same time. So we have questions regarding the French power market and notably about the export capacity from France to eastern borders that were supposed to end this month, mid-October. So do you have news about that and possible continuation of those issues?
Well, I haven't seen any communication from RT, but levels, if you look at the cumulative export levels, they've really been really steady since the end of the issues in spring. So we're assuming that the issues are mainly resolved. They can very briefly be back as they could be local congestion, but it's not really having a big impact on the market as it used to be. Also, RT has taken steps in spring to better optimize its grid, let's say, in the day rate calculation, so it doesn't have to take last resort measures. So now the things are looking better for that issue, that's for sure.
Okay, thank you, Luc. One last question. So again, regarding French power prices, so there is a strong gap between the Cal 25 price, which is at 75 euros per megawatt hour, and the realized price for this year for the French power market. If you take the average of spot power prices and the balance of the year, we are more around 50-55 euros per megawatt hour. So what explains such a difference between this year price and next year forward price?
Well, you have we've really had exceptional prices this year to the downside. Prices in spring were really low and are basically crushing the average. So you need to look at more recent year-to-date spot prices, I think, averages, and take out those outliers as they are not under any. They are basically in the 95% percentile, so they are not likely to reproduce. We are likely to have closer to normal hydro generation in the future. A bit also probably a less windy winter than last year. You could also have colder weather. So you have all the risks that are being priced in. As Cal +1 forward is still a forward contract. So until delivery, we still have all the risks, including geopolitical risks that are still embedded in the price. So, and which are mostly skewed to the upside. So that's why you have such a big gap between spot and Cal +1.
Okay, thank you, Luc, for your answers. So thanks to those who took the time to answer the survey. It's now time to close this session. We'll meet again next year in January for the first webinar session of 2025. So thank you all for your attention and have a good day, and see you on the EnergyScan platform. Goodbye.
Bye-bye.